Good evening, viewers. So today we are focusing on financial statement presentations. Um, Earlier on, we discussed uh, the differences between management accounting and financial accounting, where we were saying that management accounting uh, deals more with internal requirements, which means that the users of management accounting information within inside the organization. This is management and the owners of the business, especially if the owners are managers. So we are talking about reports that are specialized and that are peculiar to the organization. They don't have necessarily to reflect the needs of external users, which is the main focus of financial accounting, where we are saying that we have external stakeholders who might not be interested in specialized reports that are internal. For instance, if you are talking about if you want to maybe to reflect on the budgets of the organization. We also talk about specialized reports, like if you want to know more about the history or the trends of employment costs, maybe a specialized report can be processed. Then when we talk about financial accounting, it means now we are focusing on external stakeholders. These are our investors, who are our shareholders, those that are distributed all over the world. They just buy stocks on the stock market. We are also talking about maybe government, the taxmen, these the users who might be interested in our uh, financial records, which is the reports uh, which they might want to use for certain decisions, um, or decisions to do with their own investment. Now, when we talk about financial accounting, we are talking about reports that are general purpose financial reports. According to IAS1, the objective of general purpose financial statement um, is to provide information about the financial position, the financial performance, and the cash flows of an entity. And as we said earlier on, this information must be useful to a wide range of users in making economic decisions. So the information that should be provided is in these financial statements, it's information about the assets of a entity, the liabilities, equity of that entity, incomes and expenses, including gains or losses, contributions, and distributions to owners, and the cash flows. So we are going to discuss the components of financial statements as per IAS number 1, which is 1.10. And the key components of these financial statements are the statement of financial position at the end of the period, statement of profit or loss and other comprehensive income for the period, and a statement of changes in equity for the period, a statement of cash flows for the period, notes comprising a summary of accounting policies and other explanatory notes. So today we are going to look at a sample presentation of financial statements for a sole trader. Basically, what I'm going to do is almost like a template that I'm going to present here. It will show you how you can present this financial statement, but the details on how to come up with those figures will be presented in the next video. Um, so I'm going to share the sample. So I hope this screen is visible. Let me change and share this. Right. Right. I'm sharing a slide here, which gives us a template of how we are going to present the financial statements, that is the profit or loss and other comprehensive income for a sole trader. And then I will also share the statement of financial position. And then I will also highlight how we can present the notes for these financial statements. Um, just in a moment that my machine will be able to run this slideshow. Uh, right, so here we are. My machine is not running the slideshow here. I'm not sure why, but possibly we can all see the. So let me use the slide as it is without running the slideshow. So according to IAS1, this slide has been prepared according to IAS number 1, International Accounting Standard number 1. So let us look at uh, this sample. It's a hypothetical company called Sole Trader Soko. Statement of financial profit or loss for the year ended 31 December. So you will realize that we have a line here called revenue, which is not number 1. And then we have cost of sales, which is not number 2. And these are the figures. And to show that cost of sales will be deducted, it means we have to put in that in parentheses, which is what I've just done. And then the net of the two figures, revenue and cost of sales, will give us the gross profit. Then we are going to calculate the operating expenses here. we'll get the total of operating expenses, which will the figure which we'll insert here. But let us notice that the figure of the operating expenses is coming from these figures here, which I have included in this box here, which means that if you add these figures, they will be able to give you this figure here. And so you can see that this figure here is in parentheses, meaning that this figure gross profit here, we are going to deduct the operating expenses, and then we get the net profit, which is this value at the bottom. So this is just a hypothetical sole trader that I have presented here, but further to this, I would like to explain how we generate the figures. The figure revenue is a figure being generated from sales, which is this figure here. Then returns, these are sales returns that we are going to less here, and we less when we are lessing, we show by inserting the figure which is in parentheses, as I have done there. Then the net of sales and sales returns will give us this figure, which is our revenue figure. So this figure of revenue here is the figure that we bring to the financial, to the statement of profit or loss and other comprehensive income, which is this figure here. So as you can see that there is a note here which says note 1 revenue, and this is how our revenue is calculated, which means in the trial balance you are going to have this figure, which is sales. It will be given, and this figure will have a credit balance, and then we will have returns. This figure will also be given. If it is in the trial balance, it will be a debit balance. So then we have the net of the two, which is revenue, a figure which you will then bring here and label not 1. So this system of calculating the notes will mean that our statement of profit or loss and other comprehensive income for the year ended 31 December 2021 will be a clean statement without too much detail which will be provided in the notes. So let's come to the next figure here, which is the cost of sales. So the cost of sales is note number 2, which means we have to write N2 there. And the note number 2 is this figure here, which is cost of sales. And cost of sales is supposed to be deducted from the revenue figure to give us our gross profit. But we want to find out how we can compute the cost of sales, which means we are going to come to cost of sales to note number 2, where we put this heading, note number 2, cost of sales, and then our cost of sales comprises the following. We are going to have opening inventory, and this opening inventory is usually indicated by the date of the first day of the first month of the trading period. Usually if it is Zimbabwe, usually we have our years start in January, which means that our opening inventory will be reported as the 1st of January of every year. So in this case, we are referring to 31 December, the 31 December 2021 as the end of the financial year, which means that our opening inventory would have been 1 January, would have been 1/01 of 2021. This is, you would have noticed that if you are going to have a trial balance, the inventory which is written this beginning of the trading period will be the opening inventory. And then we are going to look for the figure of purchases, which we then add to the opening inventory. What this means is that at the beginning of the trading period, we had a certain amount of goods. Okay, so at the beginning of the period, we had certain amount of goods, and then we buy more goods. And when we buy more goods, it means that those goods that we had at the beginning of the period, we plus the goods that we have purchased, then we also include the cost of bringing those goods to our warehouse, which is carriage inwards. What that means is that um, this could have been the cost of the goods that were going to be available for sale, assuming that there was not going to be any returns to our suppliers. But in this case, if we have returns, it means that we have to deduct these returns because they are not part of goods that are going to be available for sale. So we deduct the returns. Then once we have done that, we have the goods that are available for sale. So I would prefer that we put this figure here, and then we, unfortunately, uh, my slide is not running well, so I'm unable to um, underline, but I should have underlined on top of this on top of these figures. Um, I should have underlined on top of these figures here, the goods available for sale. And then, since these are the goods that are available for sale, we want now to look at what remained in our warehouse. So if we deduct what remained in our warehouse, which is usually, this is supposed to be usually 31, the inventory at 31, 12 of 2021. So, which means that this is the inventory we had at the end of the trading period. So if we had this but we had goods available for sale, which are these ones, we deduct this, what remained in the warehouse, then we get what the cost of uh, goods that were sold. So once we So once we have these figures here, we then have to bring the cost of sales to our statement of profit or loss and other comprehensive income, which is here, this figure, note number 2. So if we deduct the cost of sales to get the gross profit, but the cost of sales are generated as I have indicated in note number 2. Then once we are done with that, it means we are now going to look at the issues to do with the operating expenses. And I have indicated that all our operating expenses will be here in the box here so that we are able to add them, and then we get this figure here. So expenses, which I have given here hypothetically, advertising expenses, we have that. Bank charges, we have that. Carriage out, we have it. So specifically, I want to mention here carriage outwards. Remember, we included carriage inwards in cost of sales, which is in the trading account. But in this case, carriage out is an expense. It cannot be included in the trading account. So please take note of that. So now we have delivery expenses, another expense, operating expense, wages and salaries, rent, electricity and water, repairs and maintenance. Then I would like to come to depreciation, which is another expense that usually has adjustments. So what we have here, we have uh, depreciation, which is note number 3. But this note is going to help us also in the statement of financial position, because we are going to generate the net book values. So what we are going to do here is we compute the depreciation for non-current assets. In this case, we have motor vehicles that were purchased at this cost. But for the past years, this vehicle has been depreciated to the tune of this value here. What it means is this value here is the sum of all depreciation for the previous years. It means that if, for instance, in year 1, this asset here depreciated by 1,000, year 2 by another 1,000, year 3 by another 1,000, it means this figure here will be 3,000. And then if it is going to depreciate by another 1,000 this current year, it means that we have the current charge of depreciation, which is this figure here. So what is going to happen here is that we have the cost. So we less the accumulated depreciation for the past years, and then we also less the depreciation for current charge. So what it means that when we are computing the net book value of these assets, it means that this depreciation plus this depreciation becomes the accumulated depreciation at the end of the current period, which then say the cost of the motor vehicle less the depreciation, the accumulated depreciation, gives us the net book value. So this is the figure that we will then find in the statement of financial position. But this is for the current depreciation charge for motor vehicle that we will find in the statement of profit or loss and other comprehensive income. So computer equipment will have the cost, accumulated depreciation for the previous periods, and then the current charge for the current period. So these two figures are all subtracted from the cost of this equipment, and then we get the net book value, which is this figure. But for the purpose of depreciation for the current period, we are going to deduct only the current charge of depreciation. The same applies with fixtures and fittings. The cost, the accumulated depreciation, then the current charge, and then the net book value, which means that these two figures here, the sum of these two figures is deducted from this cost to get the net book value. So eventually, we will find that our non-current assets, which are being depreciated, will have the net book value, which is this one, but the cost is this one. Accumulated depreciation for the previous year before the charge for the current period, which is this one, is supposed to be deducted from this figure so that we get the net book value. So this is about depreciation. So I have deliberately put this charge, current charge, in green so that we see that this total here of the current depreciation charge for this vehicle, for this non-current assets, is the figure that is going to come here under note 3, and then we put our depreciation charge there. Now, when we are now presenting this statement of financial position, what we are going to do, in this case, we are going to use the equation, the original equation, accounting equation, which says assets equals to capital plus liabilities. What it means is we are going to find total assets, and we get the value of total assets. Then we find total equity and liabilities. And then the two figures must balance if we have done all our things right. So here is the presentation. So our non-current assets will be there. We put the total of our non-current assets there. So here is the value of our motor vehicle, which is the net book value. So it means in our non-current assets, motor vehicle, we only want to pick this figure of the net book value, and then which we said that we are going to deduct accumulated depreciation for previous years. Again, we deduct current charge from the cost so that we get the net book value. Um, so the same applies with computer equipment. And remember, we are referring to note 3. It means this note 3, you have already calculated it and you know already what your book value is. And this is the note 3. So you are going to bring in the note 3 here. Again, the note 3 for fixtures and fittings is here. Then investment property, because we have not depreciated it, we just take the figure and we put it there. So the sum of these figures is what gives us our non-current assets. Then we are also going to look at our current assets, and then we put the total there. Then this box will close our current assets, which are cash, bank, accounts receivables. Usually these have got adjustments, and we are going to learn about the adjustments in the next lecture. Inventories, the figure for closing inventory, right? These inventories, we take the figure that we have indicated that it is a closing inventory. Usually, if it is in the context of Zimbabwe, we have this figure being the 31st of December 2021. Then we are also going to deal with prepayments in this, and there are so many other assets, but for the purpose of this, the scope of this lecture, we will stop with these prepayments, and as we discuss more and more and you practice, you get more types of assets, the current assets. So this is, you are going to add this and you get this figure here, which is current assets. So eventually we add this figure of non-current assets to the current assets figure so that we get the total assets. So the next thing is for us to look at equity and the liabilities. For a simple sole trader, we're expecting that we have capital, which is that figure. Then the net profit, we are going to bring in net profit. If it is loss, then we are going to deduct the loss. And also we deduct drawings. We are assuming that the equity of this or the owner of the business goes down because they've used some money or they've withdrawn some goods with a certain value, which then depletes their equity. Then we have non-current liabilities, long-term loans. Long-term loans. So if we have long-term loans, then it means that they are non-current liabilities. Then we have current liabilities in the form, for example, of trade payables, interest payables, and other accruals. So we add these and then we put them there. So what we are now going to do is to add this figure, and that figure to give us our equity. Eventually, this figure, total equity and liabilities, should be equal to our assets. And this is based on our equation, accounting equation, which says assets equals to capital plus liabilities. Thank you very much.